Well, under the program, and the PSI program, performance has been very strong. For this review that we're conducting right now, policies have been implemented as we thought they would be. And as a result, real GDP growth has been about 8.6% for the first half of 2018. And we've maintained our growth projection for 2018 of 7.2% for the year. Inflation remains low. And with inflation expectations remaining low, the monetary policy stance has remained unchanged. But maybe I should mention more broadly, this is a 5-year program. It's expiring on December 1st. And over these 5 years, we think the program has been very successful, despite several shocks, in bolstering inclusive growth in Rwanda, mobilizing domestic revenues, making reforms to the monetary policy framework, and improving financial access, and providing access to more sectors of the economy.
Now, Rwanda has experienced subdued inflation, as you've just mentioned, with relatively high growth. Is it time to consider a more expansionary monetary policy?
Well, in our view, not really. We think that that's backward-looking more, and the Monetary Policy Committee is looking more at forward-looking inflation expectations. And while inflation remains low, there are certain inflationary impulses in the pipeline, such as energy prices. So for now, they want to keep the policy rate unchanged, keep the monetary policy stance unchanged, and see how things develop. And there'll be another committee meeting in December where they'll look at the situation again and consider whether monetary policy might need to be tightened or loosened accordingly.
Now, Rwanda
but for now,
has
in the medium term, we think inflation will stay around 5%.
Well, Rwanda has in the past struggled with NPL ratios, with figures on the same missing for some PSI reviews. Do we know where this figure lies this time and the kind of risk it poses for the economy?
Yes, sure. A year ago, the non-performing loans had risen to about 8.2% of total loans. It has since decreased as of end June to 6.9%. So we do have the data. Part of that is because banks have written off loans that had not been performing for some period of time, and they were able to recoup some losses from loans that hadn't been performing for some period of time. That said, 6.9% is still on the high side for Rwanda. It's not high in general. And we see that these non-performing loans have been concentrated in certain sectors. But we are hopeful that this isn't a long-term trend. They're concentrated in hotels and transport. But we see that there are a number of business conferences booked. There's a lot of activity in the pipeline. So we don't think that this is going to be a problem going forward.
Now, we'll talk about fiscal stress now, and our debt to GDP at 49.8% in Jan 2018, the PSI review. Where is that debt now, and is the economy feeling the stress?
Well, the public sector debt to GDP ratio remains unchanged. It's a little bit lower than it was in January. And we expect a slight decline again by the end of this year. But let me explain that despite the fact that ratio has increased in recent years,
what's it about?
That increase was expected.
Bring 'em, yeah.
Well, it's basically some various large public investments and scaling up of public investment to support Rwanda's development program. There were guarantees for the Kigali Convention Center that entered into that. Expansion of Rwanda Air to do intra-African flights, and they're doing very well with that. So we knew about this increase ahead of time. And it's not the headline increase that's worrisome, actually. Rwanda's debt distress remains very low, according to the IMF World Bank analysis. Because Rwanda has had this high growth, so has a higher GDP ratio, it's diversified exports, the export base is higher, so they can sustain a little bit higher debt. So all in all, the risk of debt problems is very low, despite a small increase in the nominal debt ratio.
Just one last question. The Central Bank of Rwanda's governor, John Rwangomba, has earlier announced that BNR will be transitioning into a new monetary policy framework, abandoning the old-fashioned monetary targeting policy framework. Given the track record of inflation targeting, does this concern you at all?
Well, we've been in discussions with them about this for some time. If you look at monetary targets, it assumes that you have a certain amount of money and in demand in the economy. But as we see increases in financial deepening, more use of mobile money, the definition of money is changing. So it becomes very difficult to use those monetary targets to steer monetary policy. So there's been a move for quite some time to move, you call it inflation targeting, we would call it interest rate-based monetary policy, and it's more forward-looking monetary policy. The central bank has been putting into place the building blocks to move to that for some time. Those building blocks are that there's a deep financial sector, that there's a good interbank market, that there's movement in interest rates on the short end. If the central bank changes the policy rate, it affects short interbank rates, and that could in turn affect lending rates of banks. At this stage, we do see movement in the short end, but we don't see an influence yet on the longer end. So that monetary transmission mechanism, as we like to call it, is still undeveloped. So it's a work in progress, and we have an agreement with the central bank that it will take as long as it takes, but they're really making efforts to signal their policy intentions, to discuss forward-looking inflation expectations, and why they decide to keep the policy rate changed or unchanged. And they're also working to strengthen those markets and make the interbank market deeper and financial markets in general deeper. So it's improving the signaling, making markets deeper, and they're going to gradually move to this interest rate-based policy. And for the meantime, we're basically keeping both systems so that we can this transition can take as long as it needs.